Most people think recessions begin quietly, inside banks, stock markets, or central banks adjusting interest rates. But history shows something different. Some of the world's deepest economic downturns didn't begin in financial centers at all. They began in places where energy, geography, and power collide. A regional conflict, a disrupted shipping lane, a sudden shock to oil supply. In a global economy that runs on energy, even a distant confrontation can ripple outward through markets, currencies, and supply chains. Which raises a serious question. Could today's geopolitical tensions trigger the next global recession? The modern global economy is built on a simple but fragile foundation. Energy moves goods. Goods move economies. And economies move markets. When that chain is disrupted, even briefly, the consequences can spread far beyond the battlefield. In recent years, several geopolitical flashpoints have raised exactly this concern. Conflicts in energy-producing regions, tensions around critical shipping routes, sanctions targeting major exporters of oil, gas, and commodities. None of these events alone automatically causes a recession. But together, they expose something deeper: how tightly global economic stability is tied to geopolitical stability. To understand why, we need to look at the mechanics of modern energy markets. Oil is still the backbone of the global economy. It fuels transportation, shipping, aviation, manufacturing, and agriculture. Even countries aggressively transitioning toward renewable energy still rely heavily on fossil fuels to keep their economies moving. This is why oil price shocks matter so much. A supply shock occurs when production suddenly falls or transport routes are disrupted. In simple terms, less supply reaches the market while demand remains the same. Prices rise quickly. That rise spreads through the economy like electricity through a wire. Transportation costs increase. Manufacturing becomes more expensive. Food prices rise as farming and logistics costs climb. And consumers, already stretched by inflation, begin to spend less. That's where recession risks begin to appear. We've seen this pattern before. In 1973, geopolitical tensions in the Middle East triggered an oil embargo by major producers. Oil prices quadrupled in a matter of months. The result was stagflation, a painful combination of high inflation and economic stagnation across much of the developed world. Another example came in 1979, when the Iranian Revolution disrupted global oil supply again. Prices surged, energy shortages spread, and the global economy slowed dramatically. Even in more recent decades, energy shocks have repeatedly shaken markets. The Gulf War in 1990 briefly sent oil prices soaring. The 2008 financial crisis was preceded by oil reaching nearly $150 per barrel. And more recently, geopolitical tensions and sanctions have shown how quickly supply disruptions can move markets. Sanctions are a powerful economic tool. They are restrictions placed on a country's trade, banking, or financial systems to apply political pressure. But sanctions also have side effects. When major exporters are targeted, global supply chains must adjust quickly. New suppliers must be found. Shipping routes must change. Energy markets must rebalance. All of this introduces friction into the global system. That friction can mean higher prices, slower growth, and increased volatility in financial markets. But the real story is not just about oil. It's about how energy interacts with finance. Modern economies run on credit. Governments, corporations, and households all carry debt. When energy prices rise sharply, inflation tends to follow. And when inflation rises, central banks often respond with monetary tightening. Monetary tightening simply means raising interest rates and reducing money supply to slow price increases. But higher interest rates also slow economic growth. Businesses borrow less. Consumers spend less. Housing markets cool. Investment slows. If this tightening happens while the economy is already under pressure from energy costs, recession risks increase significantly. This is where geopolitics enters the financial system. A conflict that disrupts energy supply doesn't just affect oil prices. It can trigger a chain reaction across inflation, interest rates, debt markets, and investor confidence. And those reactions can amplify each other. Higher energy prices increase inflation. Higher inflation forces central banks to raise rates. Higher rates pressure indebted economies. And markets begin to price in slower growth. But energy is only one layer of the system. Another critical factor is geography. Many of the world's most important shipping routes pass through narrow choke points. Places like the Strait of Hormuz, the Suez Canal, and the Strait of Malacca. A strategic choke point is a narrow passage where large volumes of trade must pass through. Disruption in these locations can instantly affect global commerce. For example, roughly a fifth of the world's oil supply passes through the Strait of Hormuz each day. Even the perception of risk in that region can move markets. Insurance costs for shipping rise. Energy traders adjust their expectations. And futures markets, where oil prices are predicted, react immediately. But the economic story runs deeper than shipping lanes. It also involves power competition between major states. Global influence increasingly depends on control over energy, technology, and financial systems. Countries that export energy gain leverage when supplies tighten. Countries that rely on imports absorb the cost. This creates a complex web of incentives during geopolitical crises. Some actors benefit from higher prices. Others face rising economic pressure. Markets attempt to price all of this in real time. Investors watch oil prices, currency movements, and bond markets simultaneously. Gold prices often rise during geopolitical uncertainty because investors see it as a safe store of value. Currencies tied to energy exports may strengthen. Import-dependent economies may see their currencies weaken as energy costs rise. And global equity markets often become volatile as investors reassess economic growth expectations. But the ripple effects eventually reach everyday life. Higher fuel prices raise transportation costs. Airline tickets become more expensive. Food supply chains face higher logistics costs. Electricity bills rise in many countries where power generation still depends on fossil fuels. Consumers respond by reducing discretionary spending. And when millions of households pull back at the same time, economic momentum slows. This is how geopolitical tension can gradually translate into recession risk. Not through a single dramatic event, but through a series of pressures spreading through interconnected systems. Energy markets, central banks, debt markets, supply chains, investor psychology. Each layer influences the others. That's what makes the modern global economy both powerful and fragile. A conflict in one region can influence energy markets. Energy markets influence inflation. Inflation influences interest rates. And interest rates influence global growth. This doesn't mean every geopolitical crisis leads to recession. Markets are resilient. Energy producers adjust supply. Governments release strategic reserves. Shipping routes adapt. and financial systems often absorb shocks better than expected. But the risk grows when multiple pressures occur at the same time. High debt, rising interest rates, fragile supply chains, and geopolitical uncertainty in key energy regions. When these factors converge, the margin for error becomes very small. That's why economists and investors watch global conflicts closely, not just for political reasons, but for economic ones. The battlefield may be regional, but the economic consequences can be global. Understanding these connections is essential in a world where energy, finance, and geopolitics are deeply intertwined. If this helped you see the bigger picture, take a moment to like the video, share your thoughts in the comments, and subscribe to Rise and Ruin. Power of Wealth for more documentaries on oil, power, and the forces shaping global finance. Because in the modern world, recessions rarely begin with a single event. They emerge from systems under pressure, where energy, money, and power quietly collide.